Thank you, everybody, for coming. As Chris mentioned, I'm a brokerage manager here at Penny, and Penny's been around for about 50 years. We specialize in life insurance, of course, but also things like long-term care, disability, annuities, and tax-efficient retirement solutions. So we are product experts, but we're not just product experts. More than that, we specialize in developing plans and matching insurance solutions and tailoring them to your individual goals and needs. And that's really the basis for our discussion today, because you may have heard of different types of mortgage insurance in some way, shape, or form. And we're not talking about PMI, private mortgage insurance. That's the part of your mortgage payment that protects against defaulting for any number of reasons. But there are ways to protect the mortgage specifically in the event of someone dying. But what we want to get across today is that when it comes to life insurance, paying off the mortgage is a significant part of the plan, but it is by no means the only part of the plan when we talk about utilizing life insurance to protect our financial assets, such as a house. So before we discuss the solutions, let's talk about why this topic matters so much. Well, it matters so much simply because there are so many people in the United States that own homes. Approximately two out of every three Americans own households, or households own their homes. So for most families, this represents their largest asset, even especially if they're younger couples starting out or younger individuals starting out. The home becomes their largest asset, and also it becomes their largest bill. The mortgage payment is typically the largest financial obligation each month. And then also the house becomes part of your net worth. So it becomes a very important part of your financial picture. But beyond the numbers, we've all heard the phrase, home is where the heart is, and that's true. It's where we raise our kids, where we make memories, and the home is where we find a measure of safety and stability. So the idea of losing a home or the potential to lose the home can cause incredible amounts of mental and emotional distress. So it makes sense that people will find ways to try to protect the mortgage so they can stay in their home. But when we talk about protecting the mortgage, there's one thing really that keeps the mortgage going, and that's income. So when we talk about protecting the mortgage, what we're really talking about is protecting the income. If you paid a house off with cash, then this isn't really an issue. There's not a mortgage to protect, but if there's a mortgage to protect, we need the income. So the mortgage typically depends on the income of one or two individuals coming in consistently every month, because the mortgage will continue, the grocery bills will continue, the utilities will continue, even if income stops. There's a lot of financial consequences that come from income being interrupted. So that's really what we want to get in the right mindset of, is that income is what we're trying to address. So as insurance professionals, we've seen people plan for the disruption of income and death in a number of ways. So unfortunately, one of the more common ways these days to plan for death is not really having a plan at all. And this is evident in how often we're seeing online fundraising campaigns created after someone has died or has experienced some disabling sickness or event. I personally have been sent and contributed what I could to GoFundMe campaigns just three times in just the last year for people I knew who were sick or passed away. And when people come together like that, it is very generous, but it's simply not enough. Crowdfunding was never meant to replace life insurance because it's not enough. And research consistently shows that death, disability, and serious illness create hardships for families and individuals. And it actually affects women disproportionately. 75% of women living in poverty were not poor before the death of their spouse. And 39% of widows without life insurance struggle to meet basic needs within the first year. So death and the loss of income can create immediate negative financial consequences. Also, another solution that we commonly hear about is that I have insurance through work. And that is a good resource. If your employer does offer employer-based life insurance, you should take advantage of it. It's not about whether or not that's good. Again, it's whether or not that is sufficient. So for many employees, the employer will offer 1 or 2 times their salary in the form of a death benefit. And families will likely need more than 2 years of income to replace a lifetime of earning and on top of that, pay off debts such as mortgages. Also remember that employer-based life insurance is not portable. So if you leave, if you get laid off, or the business closes, you can't take that life insurance with you. So employer-based life insurance is a decent plan, but our protection plan should not hinge on or be overly concentrated in the insurance we have at our employers. All right, so that's a couple of situations that aren't really sufficient, but I'm sure you came here today to talk about more viable solutions that can help us protect things such as our mortgage and our home. So what are some of those solutions? Well, one common strategy that homeowners encounter is mortgage protection insurance. So not PMI, but in this case, MPI, mortgage protection insurance. So this is actually a very specific type of life insurance that's much different than what you might refer to as traditional life insurance. It's actually one of the forms of life insurance that Penny does not offer, and a lot of agents don't offer. So typically, people will learn about this policy, type of policy, right after they purchase a home or after they refinance their home. It's introduced to them through direct mailings, or their lender or mortgage provider will offer it to them. Or there are some insurance agents that specialize in this, but it is a very specific type of insurance. So, what is it? What is mortgage protection insurance? Well, the concept is very straightforward. As you would expect in the name, the policy is designed to pay off the balance of the mortgage that's remaining if the insured passes away. So when you hear that, you might say, well, okay, problem solved. That's what I want the insurance policy to do. I want it to pay off the mortgage. So if it does that, then why not just sign me up? Well, it's not that mortgage insurance is a bad policy necessarily, but there are just some characteristics you want to keep in mind as you consider whether or not you want to purchase mortgage protection insurance. So what are some of those characteristics? Well, one is that the death benefit amount often decreases over time as the mortgage decreases. So if you had a $300,000 mortgage and you took out a 300,000 mortgage protection policy, then after about 20 years, when the mortgage drops to $120,000, then your death benefit likewise will drop to $120,000 approximately. Now, that's not such a bad thing. After all, the policy is meant to pay off the balance of the mortgage. But what people don't often realize or understand is that while the death benefit drops, the premiums stay level. So you might be paying a $300,000 premium when down the road you're only going to get $120,000 in death benefit. So really that changes the cost and value profile of a mortgage protection policy in terms of how much I'm paying versus how much of the death benefit I will ultimately receive. Another very key distinction is who the beneficiary is. And on these policies, the beneficiary is most likely to be the lender themselves. The proceeds are used to satisfy the mortgage. The primary purpose of mortgage protection insurance is to protect the loan, it's to protect the lender. So that's where the death benefit proceeds are going to go. So lastly, in terms of underwriting, and this can be seen as kind of a positive aspect, with mortgage protection insurance, it's often simplified underwriting. Sometimes it might even be guaranteed approval, but more often it's simplified underwriting, which is a very streamlined form of underwriting. Typically, there's not going to be a medical exam, there's not going to be any blood drawn. So this can make the approval process much quicker and easier. All in all, sometimes there's this misconception that mortgage protection insurance must be a cheaper alternative for life insurance because there's a decreasing death benefit. I'm not getting the death benefit, so it's got to be cheaper. But the truth is that's not always the case. Streamlined underwriting in and of itself typically carries a higher premium because the carriers are carrying more risk, not knowing what they may have overlooked had they done more complete and full underwriting. So they increase the premium in order to offer simplified underwriting. So typically, if you are healthy, you might find that more traditional forms of insurance may cost the same or even be a little less expensive. But in any case, it's worth looking at the options. So if you are a homeowner who wants simplified underwriting, maybe you have some health concerns, and for whatever reason, you just want a very specific, focused policy that just addresses the mortgage balance, then mortgage protection insurance could be for you. It's just important that you understand what it does and what it doesn't do before you purchase it. But on the other hand, what if the goal isn't just to protect the life and the mortgage? What if it's to protect other financial concerns? Well, that's where you might look at more traditional forms of life insurance, such as term insurance, which is designed to protect the home and the family. So with term insurance, traditional term insurance, you can select a term that will match the mortgage, the length of the mortgage, 10, 20, 30 years, or whatever it is. But the biggest difference between traditional and mortgage protection insurance is that both the death benefit and the term and the premium stay level. So if you purchase a $500,000 term policy to address a $500,000 mortgage, in 20 years, when that mortgage is paid down, the death benefit on your term policy will still be $500,000. And that represents tremendous value. Another important distinction is that the death benefit or the beneficiary that the death benefit will receive is going to be whoever you choose, which is often a spouse, an adult child, or a trust. Whoever it is, whoever you decide to be the beneficiary, they will receive the death benefit and be in control of what to do with it. So when we think about financial protection, the mortgage is certainly important, but there's typically other obligations the family will need beyond the mortgage, whether it's replacing lost income or funding things like car loans or education expenses down the road. So as an example, if you have a $500,000 mortgage and a $500,000 term life policy, and a few years down the road, the mortgage is paid down to $250,000 and someone dies, well, the beneficiary will get $500,000. They can choose to pay off the balance of the mortgage, and then they'll still have money left over to address other needs and concerns. So, all in all, mortgage protection insurance focuses on the mortgage, it benefits the lender, and it ensures that the balance of the mortgage is paid off. Traditional life insurance focuses more on the family. It benefits the family and offers financial security now and in the future. So this is where you really need help from an expert like someone at Penny to decide which one would be best for your particular situation. But up until now, we've discussed what happens if somebody passes away. But it's also important to consider, what if you don't die? Okay, so disability is a leading cause of foreclosures, medical issues, and the loss of income that follows major health events contribute to a lot of foreclosure filings. So then the question is, what if you don't die? What if you have a cancer diagnosis? What if you experience a heart attack or some other type of debilitating disease? Wouldn't it be nice if the policy that we use to protect our mortgage and our family if we died could also protect us from other types of life events? And this is where living benefits have become a very important part of life insurance conversations. So let's go through a couple of the common living benefits that are oftentimes included in traditional life insurance policies. So one of them is critical illness. In the event of a heart attack, a stroke, or certain cancer diagnoses, these can create significant financial stress. So what the critical illness rider does is it allows you to access a portion of the death benefit while still living if one of these qualifying illnesses occurs. Now, each carrier may have its own definition of what a critical illness is, But what you see on the screen are some of the more common ones, such as stroke, heart attack, or cancer. So the purpose is to provide financial flexibility during a difficult time when the expenses are still there, but the income may decrease. I actually had a friend who had a very traumatic event, couldn't go back to work, but all of their PTO was gone. He had no more paid time off. I advised that he check his life insurance policy to see if there was a critical illness rider, and in fact, there was. And it was a tremendous help to him to bridge the income gap until he got better and was able to return to work. So, critical illness is very important. Another common living benefit is a terminal illness. Now, this is one of the more straightforward living benefit riders. As the name would suggest, if their physician deems them terminally ill, which by most life insurance carrier standards means that they are expected to live only for about the next 12 months. If that's the case, you can accelerate the majority of the death benefit while you're still living. This is a tremendous benefit to those who find themselves in that situation for the insured and their families. You can use the funds to address the mortgage for sure. Some individuals use the funds in that situation to address medical expenses, to provide travel support for the family, or to simply just focus on spending meaningful time with loved ones during a very difficult situation. And also, it gives them the opportunity to receive the death benefit and discuss what to do with it as a family, rather than having their beneficiaries have some confusion on what to do with it when their loved one passes away. So, terminal illness is a great living benefit. And then lastly, chronic illness is also a great rider. It's a special type of illness to where if you can't perform two activities of daily living, then with here too, you can accelerate the death benefit in that case. Oftentimes we associate this with older age, but this can also be as a result of some type of sickness or accident, because all you have to do is qualify by not being able to perform two activities of daily living, such as what you see on the screen: dressing, bathing, eating, mobility, continence. If you can't perform two of those, then you can accelerate the death benefit. Long-term care insurance is a huge topic right now. Not enough people have a resource to fund that type of care. So this is not a replacement, but it is a great source to provide some funding when people find themselves in long-term care situations. All right, so we talked about if you die, how we can protect a mortgage. We talked about if you get sick or have some type of illness, how the mortgage can be protected. And there's resources for that. But then there's also the other question. One last question. If everything goes according to plan and we don't die or become sick prematurely and the mortgage gets paid off, then what happens? Does your life insurance needs disappear along with the mortgage? Do we still need or have any value for life insurance beyond that? Well, for most people, they always will have a permanent life insurance need to some extent. And here's where we're finding among most people, they're realizing that permanent life insurance has tremendous value for a number of reasons. For one thing, it can provide for a spouse. There's something called a widow's penalty. It's not an actual penalty, but it addresses some of the financial hardships that somebody faces once they become a widow, such as reduced income, or yet, and at the same time, having higher taxes because you're a single tax filer. So life insurance proceeds can help offset some of that. It can be good for legacy and estate planning, because depending on how much your heirs receive or what types of accounts they receive, non-taxable life insurance benefits can offset some of the taxes that they might face. It can help fund education costs. There's a lot of ways to fund education costs. Life insurance cash value is a great way to supplement that. Emergency funding is a great way to use cash value life insurance, and it can supplement retirement income. It can be used in all of these ways because the cash value that grows inside a life insurance policy can at some point be accessed in a tax advantaged way. So permanent life insurance policies can be a great supplement to term policies that specifically address the mortgage. What we're seeing is a lot of people buying both a term permanent solution that can be very good for not only death benefit, but can be used in a lot of ways that can address other financial goals and concerns. All right. So, all in all, oftentimes my family members, knowing what I do in the financial industry and in insurance, they'll oftentimes ask me whether a particular insurance product or a financial product is good. So what I always tell them is whether or not something is good is relative to what you need the money for. So in this case, neither mortgage protection or traditional life insurance is inherently good or bad. It all depends on what you need the money for, what you want the policies to accomplish for you. And at Penny, we are really good with talking to the person sitting across the table from us, getting an idea of what's important to them and what they want the policy to accomplish. And then from there, tailoring a solution around their specific needs. So our ask today is that you would consider calling us, whether you're looking to purchase more insurance or if you already have insurance, and we'll tell you if what you have or what you're thinking about purchasing will address your specific needs. It's vital that you consult with somebody like at one of our experts at Penny before you make any decisions like that, so that you know you're getting the most value for what you're doing, and the life insurance will accomplish exactly what you intend it to. So hopefully that helped address how you can protect the mortgage and so much more. If you have questions, which this may have raised some questions, which is good, you can talk it over with us. Again, I'm Josh Rem, direct brokerage manager for Penny. My number's there. Myself and other experts here at Penny are standing by and would love the opportunity to help you and guide you through these decisions. Uh, that's what I got for today, Chris. If there's any questions, we can address those. Or
Doesn't seem to
otherwise,
be any questions.
okay.
But if they do have questions, what would be the best way to contact you?
Yeah, so email's good, but I'm always available by phone. My number's there on the screen, 1-800-823-4852, extension 8745. So reach out to me if you have any question, big or small. Certainly, if you're contemplating buying something, or importantly, to review what you have, and I'd be happy to speak to you about it.
Thanks so much, Joshua. This is actually the second episode of our new consumer webinar series. We will be doing live episodes every week. Also, everyone that registers will receive a recording of the webinar. So thanks again, everyone, for joining us today, and we'll see you next time. Take care.